Welcome back to Point in Issue. We're talking about wealth accumulation with Ms. Gerald Johnson, financial advisor from JN Fund Managers. Now, Gerald, you've spoken many times on this program about systematic investing as opposed to lump sum investing.
Yes.
Let's just go through that very briefly.
I would advocate systematic investing for a few reasons, especially in the context of what's been happening over the last year and a half with the volatility of the markets. So if you're actually investing in the markets, you benefit from, buying when prices are low, buying when prices are up a little, and it just kind of averages out. And what happens is the average cost of the units that you buy end up to be lower. So that actually benefits you.
This actually relates to diversifying one's portfolio.
Absolutely.
But when we look at some of the companies that failed during 2008, would a diversified portfolio really have helped the investor?
Yes and no, because what happened is, even though, yes, some companies failed, but the entire market and confidence in the entire market was eroded. And so the entire market as a whole, didn't matter whether you were investing in the Asian market or you're investing in the North American market or, the emerging market, it didn't matter. Everywhere took a hit. Now the other side of that is, if you had a diversified portfolio and say a lot of your cash was in money market instruments. Now, the money market instruments didn't take quite the hit because remember, there's not as much risk in it. So the ability for it to drop is much lower, and the ability for it to increase is also very low as well.
Which of these asset classes would you advise?
It's really going to depend, again, what are the objectives. If you have a long-term strategy, then you could be in the equities market. But if you're looking for short-term, especially when you look at our Jamaican dollar and the Jamaican dollar denominated investments, you could look at government of Jamaica securities because interest rates have gone up and you're not assuming more risk, with the portfolio.
But you're talking interest rates in a dollar that's devalued.
Right, and so when you do the analysis and you really look at it, how much are you gaining by getting 25% on your 1-year instrument versus keeping it in US and getting 6 or 7%? How much does the dollar have to devalue for you not to gain doing that? And right now it does make sense. But if the dollar goes ahead and devalues 50%, well, maybe not.
No, that we're saying it's going to devalue 50%.
Exactly. But those are the extremes that you'd be having to look at. And that was the government's other reason for pushing up interest rates. They want the psyche of the investor to say, you know what, it makes more sense for me to leave my money in the Jamaican dollar rather than chase after the US.
And that does help.
And so that really does help.
Did it really work though? With as bad as things appear to be now, if they had not done that, would we have seen a situation that would have been worse? Is
it working? With the dollar losing 4%, over 4% this year, some would say no. There's supposed to be some extra liquidity coming into the system, which means more money coming in, more US dollars. Is that going to work? It really stands to be seen. So regardless of what's happening, I think people need to take an approach to their portfolios and their investments that doesn't really depend on the circumstances. And that's why I also talk about systematically investing versus a lump sum. Because if you have a lump sum approach, and you say, every 6 months I'm going to put a lump sum in, or every year, or just when my bonus comes, that's when I'm going to invest. Depending on the situation and what's going on in the market, you may choose to stay out, right? And so you could lose various opportunities by just, analysis, what do they call it? Paralysis of analysis. Yeah. And so the discipline of systematically investing, despite what's going on, is especially important when you have a long-term goal in mind.
Again, with the volatility of the market, how much of my portfolio do I want to be in cash?
Again, that is going to depend on what your objectives are. Because really what you need cash for is income, right? So if you're near retirement or if you are in retirement, you need to keep a significant amount of your portfolio in cash or near cash, because what you're needing is income, right? So then you're looking at fixed incomes, you're looking at bonds, you're looking at your repos, things like that, every 3 months or every month, there's a certain amount of cash you need for your living expenses.
We didn't get into the presentation as we had planned to. So what's going to have to happen is that I'm going to have to bring you back on another program where we look at the presentation. Gerald, thank you for joining me on Point in Issue.
Oh, my pleasure, Bob.
You're watching Point in Issue. We'll be right back.